Hello, this is Bob Steele. In this lecture, we will take a look at a problem that will be similar to a homework and or assignment. The problem will look like this. We're going to be putting the problem into an Excel sheet that will look like this. The numbers will change. The format will look much the same in variations of this problem. You can use the worksheet in different variations of the problem. I do suggest using an Excel worksheet because it will really help with the calculations. It will help you work the problem over if you need to do that. It's good to just know the formatting of Excel. So I suggest putting the numbers into the Excel sheet. If we take a look at the problem here, we got the following selected transactions for this company. And basically what we're going to do is we're going to be talking about the difference between receivables, accounts receivable, and notes receivable. And we're going to be transferring between the two in order to recognize that difference. Main difference being that notes are going to be charging interest because they're generally longer, generally have a contract, and they generally charge interest on that. So if we look at Connect, this problem's version in Connect, you'll note that we have this tab at the end, which is going to be to calculation of interest. I suggest that we may want to do that first because it'll calculate the interest for us on all these calculations. Also note that in Connect version of this, we're basically assuming that 2014 has happened and that we are just recording the entries for 2015. So we're not recording these two journal entries. We're just going to calculate the interest on this loan so that we can record everything basically in 1 year. So let me break that down and tell you what that means. So first we'll start off with calculating the interest on this loan that happened in 2014. Then I'm going to basically calculate all the interest on the loans that started in 2015, and then we'll go record the journal entries for 2015 in relation to the loans that we have calculated down here. So the 2014, we accepted a 14/4 60-day 7% note dated this day in granting Danny Todd a time extension. So we're going to calculate this in terms of the maturity and in terms of the cutoff date. So how much interest are we going to get in terms of the maturity of the note, the full term of the note? How much are we going to get in terms of the cutoff date, in this case being December 31st? So we know the note in both cases is 14/1. That's the principal of the note. We're calculating interest being our goal here. The rate is 7% in both cases. Now, note that 7% is there because we changed the cell to percent. Notice if you were in a different cell and you put 7, that's not a percent. A percent is 0.07. And then if we made that a percent, then we change the cell, that would be 7%. If we put 7 and we change that cell to a percent, you'll note what happens. It makes it 100 because if we move the decimal 2 places over, it would be 700. And if we put a 7, it then puts 7%. So keep that in mind when you're using percentages in Excel. Then we can go ahead and multiply this out. We're going to take the 14/1 times the 7%. We come up to the 987. Now note that means basically that we're talking about 987 at 7% a year. So whenever we talk about 7%, whenever we talk about any percent, if we said that someone pays mortgage on their house at 5% or so, we mean 5% a year even though they pay monthly. So then we have to somehow break it down to how much interest they're going to pay for 1 month. And the reason we do that is because, if we were talking about an interest rate per month, the interest rates would get really small and they wouldn't be standardized. So we standardize the interest rate and then we kind of figure out how much it would be monthly. So let me see how we could calculate that a couple different ways. So we could say, okay, well that's how much it would be for a year, and let's break it down to how much it would cost per day then, if assuming that there's 360 days in a year. Again, there's 365 more like, but let's say we said we're using 360 because we're saying 12 months times 30 to make an even number of 360 in a year. And if we're using that as our base, then we can divide this out and we could say, well, that means that if that's how much for a year, how much per day, we can have 2.74 per day. How many days for this note? We got 60 days up here. So then we could say times 60. So that means that if it's 274 times 60, we would come up to 164.50. Now note that this 2.74 may be rounded here. If we add more decimals, that it's actually a rounded number, and this is not an even number. So if I was to make it even, just by formatting, I could say this is the same number even because all I did was take off the decimals in this last cell here. So that's one way to calculate it. Now, note there's other ways to shorten that calculation, but this kind of breaks it all out. We could also start, remember here, we could say, well, if the loan is 14,100 and we're saying it's times 0.07, that's how much per year, remember? And we could say, instead of breaking it out into days, we could break it out by month. And we could say, well, 60 days is about 2 months. So if we divide it by 12 months, it would be 82.25 a month times the 2 months. And that would give us a similar type of calculation. Other way we could do it is we could try to break the interest rate down to a monthly total and then break it out that way. We could say, well, if it's 0.07 for the year, we could say, let's divide that by, we could break it down to a daily total divided by 360. That would give us this number, and then we're going to say times the 60 days, in this case, that is being covered, and we have this would be the interest amount. And so that would be, 1.1. And notice again, this is really small interest amount. That's why we don't calculate interest that way. But then we can multiply that times the 14.1, and once again we'll get the same 164. So just keep that in mind whenever you're talking about interest. You're talking about basically for a year, you got to break that down into whatever period is going to be covered. Now we can do the same calculation. So we can do the same calculation over here. Just make sure you get the same 14.1 over here, and we're going to say it's the 14.1 times the 7%. And then we could, once again, divide it by the 360 number of days in a year. If we round it, 12 times 30, 360 days. So we're going to take this divided by this. That's the number of days. Now we're going to say, well, how many days were in December, not how many days till maturity. So in this case, this happened on December 16th. One way we can do this is we can say, well, that equals, there's 31 days in December minus, in this case, the 16th. So that would give us, the 17th onto the 31st. So we're talking 15 days here. So then if we multiply that out, the 274 times 15, we get the 41. And then if we rounded that, once again, we'll get the 41 even. All we did was take off the decimals by formatting the cells, by increasing or decreasing decimals here. All right, so we can do the same types of calculations down here. And once again, Connect is going to give you the first row of these numbers. So I'm just going to basically do the same thing. I've broken out the calculation in a little bit longer format like this so that we can see the calculations here. So the principal for a midnight loan that we're going to have a 6200 midnight loan that we'll talk about as we go through here. And the rate that they're going to give us in that one is going to be 7%. So once again, your percentages may change in your scenario. They'll give it to you on that third tab. So the third tab in Connect, you want to get that and pull this information in here. So then we can multiply that out. Same way, we're going to say the 62 times the 7%. I'm going to divide that the number of days in a year. In this case, it's 360. And we're getting that once again by saying it's 12 times 30 to give an even number. And so we're going to say this divided by the number of days would give us the 1.21. Remember, that might be rounded, but that's okay. And notice Excel calculates it as if it wasn't rounded, even though it's only showing us what is rounded. And so keep that in mind if Excel gives us a number that you didn't quite expect or is a little bit off than what you're getting in a calculator. It's because this number is really being calculated using a number like this instead of this. That's all you can see, but Excel is using the full number there. And then, so now we're going to have the number of days in this calculation happen to be 90. So this is a 90-day loan, and the interest rate, so then the interest on it would be the interest per day times 90 days. And then once again, if we were going to round it, it would just be 109. So then we have a loan from private. It's going to be the same thing. We'll calculate. So this happened here. It's on the 17th. We have a 3008, and once again, Connect will basically give you that. So we're going to make this into a note here. So we're going to say there was a 3800, and once again, the rate's going to be 7%. So 7%, that's already formatted for us. So we got the 38 times the 7%, and I'm going to do the longer calculation to break this out. That's for a year. And we're once again going to say there's 360 days in a year. Therefore, how much would it be per day? If it's that per year, divided by the number of days in a year, rounded, and then we're going to get the 0.74, which is rounded. And then we're going to say how long is this note? It's 30 days. So it's 30 days. Therefore, we're going to take the amount per day times the 30 days, and once again, it's not quite rounded. We can then round it to about 22. Once again, Excel is going to use this number, not this number, even though it's showing this number if we reference that cell. So if we type in the number 22, we might come up with a different number than Excel calculates because Excel is using the actual number in there, even though it's only showing 22. So the next one is actually down here on August 8th, accepted an 8/8 50 90-day 10% note, this time from Mulan. So we're going to have to go over here and we'll say this is, once again, we're going to calculate these first. Say there's an 8850 note here, and this time we have a 10% rate, so it's 10%. And once again, remember that's percentage. If it was a decimal, it'd be moved 2 places over to the left. It would be 0.1 in terms of a decimal format. So we have this times the 10%. That would be the interest for a year. We're going to divide it by 360 days in a year to say that if that's how much for a year divided by 360, that would be how much per day. And how long is this note? It's going to be, in this case, 90 days. So we're going to say that there's 90 days now. So if this is the interest per day, like the rent on the loan per day times 90, that would be the amount per day. If we're going to round that to no cents, it would be the 221. All right, and then we're going to have another note over here from Midnight. So then we have another note from Midnight, and this is going to be 6309. I'm just going to give you these numbers, and it's going to be for 7%. And therefore, once again, we got the 6309 times the 7%. That would be for a year. 360 days in a year, about rounded. So that amount per day for a year divided by 360 gives us the amount per day of 1.24. And in this case, we have 46 days. 46 days that we are covering here. So then we're going to say it's the 1.23 times the 46 days, once again to round that to the 56. And then finally, we have Carson on November 2nd that, I'm sorry, September 3rd, a 2150 60-day 9% note. So once again, we're going to put that in first before we calculate this all out and do the journal entries. And then so we have this amount, and the percentage is 9% this time. Therefore, we're going to take the principal times the percent to bring us the percent per year, 360 days in the year. Therefore, we can take the amount of interest per year divided by the number of days gives us the 54 per day, and this is a 60-day note. So we're going to say 60, and then we're going to multiply the amount of interest per day times 60 days, and if we round that, we come up to 32 per day. So now we're going to take this information and we will calculate the journal entries. Now we're going to have 2 sets of journal entries, so we might want to hide some cells. I'm going to post the journal entries to the trial balance, and that will give us the balances over here. So first thing I'm going to do is hide some cells. I'm going to put my cursor on the L so it looks like that. Not like that, but like that. Left click and drag over, let go, right click and hide. So we can work out with journal entries right next to our where we're going to post these to see the activity. And I have grouped these in terms of the accounts receivable. The way we will generally see it is that they will be grouped in one account oftentimes. So your Connect will group it a little bit differently, but I'm going to have the subsidiary ledger over here for the receivable. So this is what adds up, and this will be calculated when you enter this data in. So this data will be needed to enter first, so it will populate this. Then we can see that this ties out, and this ties out to your accounts receivable here. So that's how you're usually going to see an accounts receivable on the ledger, because it'll have one account here backed up by a subsidiary ledger. Unlike notes, which on the trial balance oftentimes we will list notes separately, because oftentimes the notes have different terms and we want to track the interest, therefore they're often listed separately. When we put them on the balance sheet though, we will generally group them all into one account called notes receivable. So keep that in mind as we go. We're going to scroll back over here and just go through these transactions now. So I'm going to move this over and say that once again we're moving to the 15th. So we're starting down here, and we'll start with the first one on February 14th, 2005. So this says we received Todd's payment of principal and interest on the note dated December 16th. So if we take a look at this, we have now this information will populate the note over here. So